Welcome to The Point. I'm Neil Stanley, and this is episode 17. We're going to talk about interest rates and when the Fed might start raising them. We're going to identify some information focused in on unemployment, full employment, inflation, and price stability. So to help us set the stage for this, we're going to pull up data from the Federal Reserve economic data. We're going to look at the unemployment rate going back a ways, and we find that today unemployment is at 4.8%. Full employment means a low rate of unemployment. And if you look back over the last years, since in the last 40 years, the number of times that we have been below 4.8% have been fairly few. Most of the time, about 80% of the time in these last 40 years, we have had a higher unemployment rate than we have today. So full employment is one aspect of interest rate management. The other aspect is inflation and price stability. When we look at the consumer price index, we know that a lot of conversation has occurred around that recently about it being transitory, whether or not it's sustainable. And if we look at the data, we see it does bounce around. There's good justification for asking, is it sustainable when we look at the consumer price index? But we know that it is definitely at a level that is much higher than what we've seen in the past. So that brings us to the question, how does this all kind of come together? And so if we look back at the Great Recession, we know that we went into the Great Recession and unemployment went up. It went up over 10% at that time. And so with that 10% unemployment rate, we saw the need to work on the economy, get things going until interest rates rose when we hit a level of 5% in December 2015. That was the first time we raised interest rates. So the unemployment level, I think, is a key metric in studying where that is at. We can see the blue is the gross domestic product. It was rising and certainly recovered from where it began the Great Recession. It recovered in the early years following that, but it took a while for us to start raising rates. But today we are back to where we were when we raised that first increase in Fed funds. So when it comes to full employment, we can see that there is a case to be made that we are at that level. So let's look then at price stability. When it comes to price stability, we can see that over the years, in the last 10 years, there have been many different positions. But what's so notable to me is that when we had an occasion for raising rates, even though the consumer price index was not positive, there was really no indication of inflation, we still raised interest rates. Today, if you look at where we were December 15th and where we are today, the inflation is a much different level. And so when you put it all together, it's hard not to envision that the Fed has to seriously consider going off of the floor of interest rates when we have an unemployment level of 4.8, again, below where we've been 80% of the time. We've been above this kind of level. So that's what we wanted to bring to you today in terms of a To The Point episode where we've identified where we were, where we are, and how the steady increases in interest rates made sense back then to the Fed. We don't know exactly what the crystal ball should tell us, but we do know this: we are always open for conversation with you. So if you want to set up an appointment about this or another topic, feel free to do so. I hope you have enjoyed this episode of To The Point. We look forward to talking with you again soon.